Hey, good afternoon. I want to welcome you to today's top 10 stock pick sneak preview. You got John Hopkins here. Tom Bowley going to jump in just a minute. Hey, if you're new to earnings beats, I want to welcome you. I think you're going to find this to be a quite interesting event. Of course, all of our wonderful subscribers, many have been with us for many years. We really appreciate all of your support over the years. So tonight's event, like all of our events, will be recorded. If for some reason you're unable to stick around for the entire event, no problem. You will be able to listen at your leisure. Of course, this is a sneak preview to the actual top 10 stock picks event that'll happen sometime next week. Also want to remind people, today is an event that is open to the public. Whereas next week's event, you have to be a subscribing member, including anybody who's on trial. In addition, tomorrow night, we've got our Options Max Pain webinar, always a great one of my favorites. Third Friday of each month, the monthly options expire, and Tom will be talking about the market, the major indexes, as well as some individual stocks that could make significant moves between now and options expiration. You can find out more information on the website. Anyways, I know we want to get this thing going, so let's make sure Mr. Bowley's in the house. How's it going, Tom?
It is going well. Done with a lot of traveling, so been spending the last hour or so trying to put together some of the things that we like to talk about for this, but
okay,
ready to go.
All right, so I'm going to go ahead and just step aside, and if there's some questions, I'll try to answer them a long way, and Tom, if he has some time, we'll answer those remaining once he's done. Okay, man.
All right, sounds good. First of all, just want to welcome everyone. This is a fun event for me. I like to do these sneak previews and the actual draft, the portfolio drafts, because it gives me an opportunity, first of all, to do a lot of research into many of the stocks that we will consider. And I'll talk a little bit about the methodology and some of the things that I look at and the themes that we're looking at currently in the market in trying to put together portfolios that, in the end, our goal is to try to beat the S&P 500. I will say that we have three portfolios, the model and the aggressive, both of which do tend to be fairly aggressive. And the income portfolio is our third one, and that one tends to be more conservative. But because I believe we're in a secular bull market, they tend to favor growth stocks over income producing stocks. And our income portfolio has underperformed the S&P 500 since its inception, but that's what I would expect it to do in a secular bull market, because again, growth generally is going to lead, and so many of the dividend payers are more value-oriented stocks, so they're probably going to underperform. So you just have to keep that in mind. Now, the flip side is, if the market does go down, you would expect more often than not the income portfolio to do better than the aggressive portfolios. But keep in mind, the last 3 months we went through a correction and money rotated more towards growth. The actual growth versus value ratios that we like to follow were going up. So this wasn't your typical correction that we saw over the last 90 days, and many of the value-oriented stocks actually performed worse than the S&P 500, which is unusual, which is another signal why I believe the stock market goes higher, but we'll talk about some of that in just a bit. But I'm going to start off looking at some of the things that I think are important in trying to put together these portfolios. And then, at the end, as I usually do, I'll take any questions that you have, and I'll try to answer those the best I can. So I'm going to go ahead and start. And I'm going to start off with a chart I always like to start off with. Anytime I'm looking at the overall market, I really want to take a look at the big picture. And this is just a very, very simple look at what happens in secular bear markets You can see the red shaded areas. This is a 100-year chart, by the way, of the S&P 500. It's a 100-year monthly chart. So they don't get a whole lot bigger picture than that. I mean, I think we're going back quite a ways here, but this is just kind of show you the grand super cycle and how, these cycles tend to play out in the stock market. Many times what you'll see is the secular bear market lasting usually about 12, 13 years, maybe around a dozen years. The secular bull markets, when they get going, they tend to last a couple of decades. And so if you see, I mean, this was kind of a stretch because this was back in 1929, and we had that really serious crash. And then, of course, followed it up with double peaks right here. And you'll see that these double peaks, very similar to what we'll see during the other secular bear markets, the one in the 70s, also the one in the 2000s. You can see pretty clearly that double top there. What characterizes these secular bear markets is that we don't generally see new highs for 12 years or more. And so they're really difficult periods for anybody investing because it's hard to make money. I mean, if the S&P 500 isn't going up to a new high over a 12-year period, it's going to be really difficult for your investments, your 401ks, to perform well. So you have to be able to recognize these when they get started, and you have to be able to differentiate between a secular or a long-term bear market and a cyclical or a short-term bear market. We've had 3 bear markets in the last 5 years. If you look at this chart, you can go back to 2018 right here. We lost 20% on the S&P 500. That was the trade war. This was 2020, the pandemic, lost 35% on the S&P 500. And then we had about a 10-month cyclical bear market that lasted throughout much of 2022, where the S&P 500 lost 28% of its value. But if you notice, these 3 right here were pretty short-term in nature, and we were continuing to trend higher. This was different. You can see the double tops here. These double tops were roughly 7 years apart. If you look back here, 46 and 39, or 46 and 37, these double tops were about 9 years apart. And then we didn't really have a double top, but we had a few tops that were fairly close to one another. And they tended to be about 5, 6, 7 years apart. But they all look pretty similar. You just don't go anywhere during secular bear markets. Secular bull markets, however, are much different. And that's when we see the market really, produce some of the largest gains that we're going to see during our lifetime, these 20-year periods. So there's the 1950s and 1960s. Here's the 1980s and 1990s. And now here we've got the 2010s into the 2020s. But if this is like other secular bull markets, we're probably only about halfway through it. Wouldn't be shocked to see this last into the 2030s with cyclical bear markets along the way. We had cyclical bear markets in the 80s and 90s. We had cyclical bear markets in the 50s and 60s, but they were short-lived. We broke out, we kept moving, and it wasn't until the end of these 20-year periods that we saw the beginning of a secular bear market, which is much more important to recognize early on, because you got to lower your expectations. You may want to invest in other asset classes, get away from stocks, or at least really reduce your stock exposure. Secular or cyclical bear markets are a little bit different because they tend not to last as long, and we tend to come out of them and go set new highs again, just like we saw after 2018, just like we saw after 2020. And I believe shortly we're going to look back and we're going to see all-time highs after the 2022 cyclical bear market. I think we're already in the uptrend. I think we're going to go back up, take out 4,600 on the S&P 500, and ultimately get back up above 4,800 to test that high at the beginning of 2022 and then break through it. I think that's probably going to occur sometime early in 2024, although I still am not ruling out the possibility that it happens this quarter before the end of the year. I think we could still see a very, very big push higher in the S&P 500. So I think we'll probably be 4,600 to 4,700 by the end of the year. I think that's probably the more likely scenario, but I would not rule out 4,800 or even maybe higher. We shall see. But purpose here is just, if you're going to put together a portfolio, looking at this, personally, I'm going to want to be a little bit more aggressive because I believe we're in a secular bull market. Not only that, I think we're continuing to come out of a cyclical bear market. And usually the first couple of years after cyclical bear markets, that's when you make, a lot more money in the market. So this is a pretty big theme. Now you might look at it and say, well, what would make you think that this is cyclical or secular bear? That we topped at the beginning of 2022, and we're just going to keep going lower, and it's going to morph into something like this. Well, a couple of things. First, you'll see pretty early on in that very first move to the downside here, the very first move to the downside here, and of course, the move down here, whichever one you want to look at. These moves to the downside were pretty swift, and we saw the monthly PPOs go negative on that first move down. We also saw the monthly RSI go below 40 on those first moves to the downside. Right here, down there under 30. Right here, we went down right to 30. And then here we were down well into probably in the low 20s. Or even if you look over here, we went down to 30. I want you to look at this move right here coming down. Where did we go? We stopped at 40, which is more typical of a secular bull market. 40 monthly RSI, 40 holds during these big moves. Here we went slightly below on a couple of occasions, but for the most part, we were above 40 all the way up to 90 during these secular bull market phases. What are we doing right now? We're holding 40, and to the upside, we're going up into the 70s and 80s. Everything still looks to me to be a secular bull market. All of my signals. Don't you think if this was going to morph into something that was really bad, like we've seen before in secular bear markets, don't you think money would be rotating away from the growth areas? That would certainly make sense to me, but we're not seeing it. Monthly PPO is actually turned up, got close to the center line, but then turned up. So it's now, we've got a little bit more room away from it to the upside. You can see throughout the 80s and 90s, same thing, going down to maybe just above the center line, turning back up. And then in the 60s or 50s and 60s, we went down right about to the center line on a few occasions and turned right back up. And throughout these entire moves with the PPO above zero and the RSI monthly RSI primarily above 40, those were secular bull markets. Exactly what we're seeing right now. So that is one of the many reasons why I believe we're in a secular bull market, and why a lot of folks are getting this wrong, because they're so focused on news. They're so focused on politics. They're not paying any attention to what the charts are saying. The charts don't care about the news and the politics. The charts are looking ahead. If the charts are seeing problems, you're going to see it in the price action. I get emails all the time. Tom, how could we be in a secular bull market with everything that's taking place in the market? And I'll just ask you one question. Which of these things that you're pointing out is the stock market not aware of? Which one of these major problems that you think we have, which one of those do the big Wall Street firms have no clue? They know about everything. The market's being priced with all of this bad news already in play. Stop trying to call stop trying to call 22 of the last 2 bear markets. That's what most folks do on CNBC. They're always trying to call bear markets. We hardly ever have them. We've had 14 bear markets since 1950. 14. 3 of them in the last 5 years. We don't have bear markets all that often. And yet everybody wants to call a bear market. Everybody wants to be a hero and call that collapse. Do me a favor. Anybody you see that constantly uses the word collapse or crash, stop listening. They're just fear mongers. How many crashes would you say we've had over the last 75 years, since 1950? I believe 73, 74 qualifies. I think 1987 qualifies. I'd say 2000 to 2003 qualifies. 2007 to 2009 qualifies. And we could probably even throw the pandemic in there. Kind of like 1987. Big, quick swoop to the downside, and then we recover. Kind of like 1987. So 1, 2, 3, 4, 5. 5 what I would consider crashes since 1950. And yet everybody keeps trying to call crashes. I ignore it all. I'm sticking to my guns. I said at the beginning of 2023, we were going to have a very good year. I said at the beginning of 2022, we were going to have a very rough year. And both years have kind of played out. I can go back to 2020, which was our first Market Vision event. We've done a pretty good job of calling the market. First of all, because I ignore all the media. You'll never get it right if you're listening to all the talking heads. They're always so pessimistic or euphoric. End of 2021, how many people were calling for a bear market at the end of 2021 or beginning of 2022, first couple of weeks of 2022? I can tell you there weren't many. We were one of them. All right. Anyway, this is kind of where I always start, this chart. Now, what about the 10-year Treasury yield? Because this is another big chart that I think is important to follow here. One thing I will say on this is that I'm kind of following this neckline right here. See these equal lows? 450, I don't know, 453, 455, whatever it is, this low and this low. Off of an uptrend, that is your neckline. We went up here, we put in a left shoulder, neckline, head, neckline. We're coming up. This may have been the right shoulder today. I don't know. I've been saying maybe we get to 480. That would make it pretty symmetrical, which would make it really easy for just about every trader to see. Anytime you get something that's really symmetrical, equal left shoulder and right shoulder, equal sides on the neckline, in between we have a higher high. That's a very, very easy pattern to recognize as a trader. Now, if it just stops here and breaks down, some will look at it and see head and shoulder pattern, but a lot of others won't see it because there's limited right shoulder in this pattern. But here's the measurement. From the top down here to the bottom, I always take a percentage. So in this case, I would do something like this. And I'm just going to kind of ballpark this, but right up in here is about 9.6%, right? So if I just grab this and I come down here, if we break down below this 450 area, I'm looking at this going down to about 410 measurement, which would be right around this low at the end of August. I think 410 kind of makes sense. Now, I don't know if it'll happen rapidly. I think we could be to 410 before the end of the year. I think it's possible. I am beginning to believe that that is the high, 5%. And I believe if we break below 450, it's going to confirm it. Now, I don't believe we're just going to go back to 0% interest rates. I think we're going to stay well above it. But if we're in an environment where rates have come back down a little bit here over the next 2 or 3 months, when you put portfolios together, you're going to want to put them together with the knowledge that rates could be lower. That's going to continue to benefit many of the growth areas. Normally, this time of the year, November into December, we see the aggressive stocks lead, but it's the more value-oriented growth stocks, if you will. I mean, more industrials and financials. We don't typically see a lot of strength in technology and consumer discretionary and communication services from here through year end, especially in December. That's when those groups tend to take time off. So I think we're probably still going to see technology do well into the end of this month, maybe into the beginning of December. But I do think at some point we're going to see money rotate away from technology. But I don't think technology will perform horribly. I just don't think that they're necessarily going to be the best performing group in the month of December. I think we will see some rotation. So that will be a factor in putting together these portfolios. We want to be in technology, but I don't know that we want to be overly in technology. And if we get a big run, I mean, it's up to each individual. We hold these stocks for 90 days, but our members can do anything you want. I mean, if you purchase these securities, it's totally on you. We are not registered investment advisors. I try to say this just about every webinar we do. We are not registered investment advisors. I am not a registered investment advisor. Earnings Beats is not a registered investment advisor. And no one working at Earnings Beats is a registered investment advisor. So we are not licensed to provide selections or recommendations, advice. I never say I'm giving advice or recommendations. We provide education. That's what we do. So if you want to follow along with the portfolios, mirror the trades or whatever, that's fine. This was started back in 2018 with the model portfolio, just to kind of use as a way of trying to demonstrate how we would try to beat the S&P 500 with a combination of both trading and investing. And I say that because if you think about a long-term buy and holder, what do? You buy and you hold for the long term. Well, what do you do as a trader? Well, it depends on your timing, but you could day trade. You could trade maybe within a few days or a week, maybe a couple weeks, maybe a month or two, maybe 6-month swing trades. I mean, lots of different trading. But what we do with these portfolios, we kind of try to marry both methods. We don't hold anything more than 90 days, but every 90 days, we reselect or redraft our portfolios to try to outperform the S&P 500 over the next 90 days. That's really what these portfolios are all about. Now, I can tell you, I don't buy them and hold them for 90 days. And people will say, well, why would you do this if you don't hold them yourself? Well, first of all, I don't hold anything 90 days. I'm just not that kind of a buy and holder or even a long-term trader. I'm more of a short-term trader. What I can tell you is that the stocks that go in these portfolios are some of my favorite stocks. And as a result, I trade them a lot when I'm trading individual stocks. Now, because of the correction last year, just because of all the rotation that we've seen really since the pandemic, I have personally done more ETF trading than individual stock trading. But there have been some individual trades that I've made. I just feel like with the rotation, it's been much more difficult. I think our results in these portfolios have not been as good the last year and a half as they were the first few years that we did, especially model portfolio. And I think part of it is just that crazy rotation that we've been seeing since the pandemic. Just can't quite trust a move for very long. This quarter, we do have Let me go ahead and bring up our portfolios. I did update it through today's close. So if you go down here, you will see our historical performance. And this is the model portfolio. Date of inception, 11/19/18. So it started back during the trade war, during a cyclical bear market. That's when we started. Anyway, since the start, model portfolio has been up about 125%. And you can see the S&P 500 has been up just a little under 64%. So we were up about twice what the S&P 500 has done. Now, in this latest quarter, which will end this Friday, you can see the model is down about a little over 1% from the S&P. The aggressive is up just slightly. And income trailing, as I would suspect, just because, again, growth has been performing well. But the long-term track records have remained pretty strong for the model and aggressive. And income, like I said, I would expect it to underperform. It does not, this number does not include dividends, by the way, which all the stocks, we don't put a stock in our income portfolio unless it pays a dividend. So dividends would close the gap somewhat, but still underperforming. Model portfolio, that's not really what we're doing now. We're doing the stock portfolio, the sneak preview. But you can see our model portfolio has outperformed the S&P 500 over its lifetime, and it's also outperforming this quarter. But the quarter dates are different, as you can see. So the stock portfolios will end November 19th. November 19th is Sunday. So technically, these stock portfolios will end on Friday at the close. So at that point, the closing price, we're done with the portfolio. So then the question is, with the new portfolios, when do we start? It used to be we would start that same day. We'd exit on the 19th and we'd buy back the new portfolio on the 19th. And then we had members write in and say, well, historically, you always talk about the 19th to the 25th not being a great time for the market. Why don't we hold off? And I thought, oh, that's not a bad idea. So now that's what we've been doing, getting out on the 19th, getting back on the 25th. However, fourth quarter is a little different than the other three quarters. The November 19th to the 25th is not all bearish. And neither is the 19th to the 25th in December. The 19th and 20th are bearish historically on the S&P 500. But from the 21st on, we actually see bullishness pick back up again. So the 19th being a Sunday means the 20th is Monday. So what I am planning to do at this point is ending the current portfolio on Friday the 17th and starting the new portfolio at the close on Monday the 20th of November. All right. So that's just kind of a little summation of some of the results that we've had. Actually, if I go in here, I can pull up stock charts and take a look. Let's just pull up the spider and we'll go in here and pull up the portfolios. So here's the model portfolio right now. These are the stocks that we have. We're going to view all. We'll put them in summary form, and I'm going to go back 3 months. Now, this is not exact because 3 months ago would have been August 13th. And we didn't start this portfolio until August 25th. And then we ended November, or we will be ending November 17th, this Friday. So this is going back 3 months, but it's not exactly, it just kind of gives you an idea of what these stocks have been doing. So right now we've got Manhattan, which has been our best performer. It's software. Look at the two best performers, both technology stocks. So if you get into technology, they're going to have a better chance of performing strongly. You can see two technology stocks there. Here's the other one, software. This one's been relatively flat. Here's discretionary, communication services. So there's an internet stock, broadline retailers, semiconductor software. These are areas that have done well this quarter. Now, we filled out the portfolio with financials, couple of discretionary. Here's an industrial, especially the financials and industrial. We have not really seen a whole lot of relative strength. And you can see they have not performed well for us, especially these last couple of stocks down here. Boeing came back today, actually had a pretty nice day. And so maybe we'll get one more week and get a run where perhaps we can get back up close to break even or closer toward break even. I think we got into Boeing somewhere in around the 220, 224 area, not too far from the high. You can see Boeing not really a great performer. So in August, it was probably somewhere around 225 and then went down to 175, but it has come roaring back and not too far. We can get back up another, a few percent, 10% would get us back probably even on Boeing. So that was the worst performer. And you can kind of see it's been split. So we had some good stocks in there, some bad stocks, add them all together, and we're essentially down about little more than 1 percentage point from the S&P 500 this quarter. Aggressive portfolio. Once again, take a look at what's working, down here what's not. Look at the 2 stocks on top, semiconductors. One right beneath it, software. Those 3 clearly best performers and have really helped our aggressive portfolio. However, look at the industrials and financials that have not performed as well. Down at the bottom, dragging the results down. So essentially what we've seen on the aggressive portfolio is really good strength in the technology area and not so good strength in industrials and financials. And they've all set one another. And we've kind of performed about the S&P, close to what the S&P 500 has done. Income portfolio, a little bit of an underperforming group here. Intel, once again, semiconductor leading. Lam Research is the other semiconductor, but they both paid dividends, which is why they're in the income portfolio. They did okay, but you get down here to the bottom. Here was a technology stock that is not doing well, and that is in the electrical components area, Vishay. Couple discretionary. Here's your financial and industrial. We did have a couple financial and industrial did okay, but here were a couple that really held us back, ADP and Unum in the business support services area, and then life insurance, both of these down 10%, 11%, that area. So we had a little bit more weakness, and that's why this portfolio underperformed. But as I said at the beginning, most of the time when the market goes up, or certainly when you've got aggressive stocks leading defensive stocks, the income portfolio is not going to do as well. So that's kind of a summary of what we've been looking at. So now this is what I'm thinking as we go forward and when we make our selections next week. What I'm thinking about, number one, I believe we're in a secular bull market, and I believe we're going higher. So I'm going to be looking for stocks that I believe can benefit in what I believe is going to be a lower interest rate environment. I believe we're going to break below that 450 level that I showed you here, the neckline. And I don't think we're just going to collapse back into the low 3s or anything, but I do think we're going to start to see the 10-year Treasury yield maybe trade in a range that's lower than what we've been seeing. For the last couple of months, we've been seeing 450 to 5. I think the next few months we could see a little bit more time spent below 4.5, maybe getting down close to that 410 target that I talked about. So lower interest rate environment, secular bull market, usually you're going to see growth lead. So expect a little bit more weighting toward those growth areas. I'll probably still be looking at financials and industrials, just because those areas do tend to perform very well in November and in December. Technology tends to tail off. And we don't want a portfolio with all of our stocks in technology. That's not really much of a diversified portfolio. That's just rolling the dice on technology. So keep in mind, when you were looking at the portfolios, you might have seen that technology was maybe 30 or 40% of our portfolios. Keep in mind, technology is 28% of the S&P 500. So if we get, we put in, 10 to 15 stocks in our portfolio, we don't want to just put 2 technology names in there. We're going to be underweighting technology. So if the S&P goes up like I think it's going to, and technology does well, or at least holds its own, we're not going to perform very well relative to the S&P if we only have a couple stocks. So we're going to be looking probably to have 30 to 40% representation, I would guess, in technology. Some of the discretionary names, probably not as much in communication services. That group tends to struggle in December. And then, like I said, financials and industrials, probably a little overweighting there. See if we can find some good individual companies in the space that also like the months of November and December. So when I'm talking about the seasonality, let me show you a little bit about what I'm talking about here. So if you go in and you pull up seasonality at stock charts and you type in XLK, you'll get a seasonality chart of the XLK, which is technology, and the default is 5 years, going back 5 years. Now, I usually will either drag this back 11 years, which will be from 2013, which is when the secular bull market began, right here. When we broke out above that double top, it was April 2013. So that's why I go back 11 years to 2013. You can see technology loves the month of November. November's fine, but not so great in December. And then the other thing you can do is compare it to the S&P 500 and go back 11 years. And you can see slight outperformance in November, flat in December. Look at communication services. Go back 11 years. And you can see November and December, communication services, not so great. But then January comes roaring back. So we'll be going from November 20th at the close through the 19th of February. So we got to keep in mind that January, over the last 11 years, communication services has outperformed the S&P 500 every single January by an average of almost 3% a month. January is by far the best month for this group. So we don't totally want to ignore communication services. And if you look at the internet space relative to the S&P 500, we go back 11 years, you will see internet has only underperformed the S&P 500 one time in the last 11 years during the month of January. And the average outperformance, 4%, 4 percentage points. So these are the types of themes that I'm talking about. Now, if we look at the XLI, which is industrials, and we go back the last 11 years, you can see 82% of the time, industrials have outperformed the S&P in the month of November. Pretty high rate. December's okay, down just slightly. And I believe if we go back all the way 20 years, you will see, look at that November, 85% on the XLI. The average in December, it's kind of an average month. January, somewhat average. February, it's a pretty good month again. So this is a decent quarter for industrials, which is why, we want to be thinking about having them in our portfolios. If we go back 20 years on the XLF, you can see the fourth quarter, we tend to see outperformance of the XLF relative to the S&P 500. And in the month of December, we average outperforming by 0.5%, which trails only April. That's the 0.7 right there, average. So financials tend to like the month of December. January and February, maybe not quite so much. But again, we want to at least be considering industrials and financials as we get into the end of the year. I'm thinking about possibly having portfolios for the first half of this quarter, and then maybe switching a couple of them out to go into January, because January is a very, very bullish month for some of the key aggressive areas like technology and communication services. So we might even want to get more aggressive going into January. So all of that's going to play a role in putting together these portfolios and whether or not we want to make maybe one intra-quarter switch. Haven't decided. I'll be thinking about that some. Anyway, so I wanted to go over one other thing tonight, and then we'll wrap this up, and I'll be happy to take questions. I wanted to go in and take a look at the relative strength of these various sectors and industry groups. So if we look at the sectors, relative strength of the sectors, here is technology. Now, this chart right up here shows us technology relative to the S&P 500. So when this is going up, it doesn't necessarily mean technology is going higher. It just means that technology is outperforming the S&P 500. Now, it does just so happen that technology is right on the brink of an all-time high on an absolute basis. It's already at an all-time high on a relative basis. I mean, we could take this chart and go back 10 years. Actually, we go back 20 years. And you can see this relative just keeps going up, up, up. And there's your absolute chart down at the bottom. So technology, I mean, if you want to beat the S&P 500, you want to be in areas that are leading the S&P 500. Technology is one of those areas. How about consumer discretionary? Well, it's definitely taking a pause, but it is starting to turn back to the upside here. So over the last month or so, it's starting to gain strength again. And notice on an absolute basis, I'm going to annotate this so you can see this. But on an absolute basis, you see these tops right here? So on the way up, we bottomed in December of last year on discretionary. We made a move up, put in a triple top. We broke out above it. We went back down. We tested that triple top breakout, and now we're starting to turn back up. That's why I tend to have a little bit more bullish feeling about discretionary, even though on a relative basis, we've been seeing a downtrend since July. I think that is over. I think we're starting to trend higher, and I think it's because we're bouncing off of support. Communication services continuing to strengthen. So while we are going into a period which maybe isn't great for communication services, and you can see we're already off the top from in October here in the fourth quarter. December is not a very good month, so we'll see what happens. But I expect by the beginning of the year, we'll be setting new highs again, both on an absolute, or excuse me, on a relative basis. I definitely believe we're going to be at new highs. On an absolute basis, we'll probably be at new recent highs, but we're not going to be at that all-time high back from 2021. Next up, industrials. Industrials, I really want to see this relative support hold right here. And it looks like we're right at it. On an absolute basis, we also have very good support at around 96, which is where we got down to recently. And we bounced off of that now back up to 102 and change. So this relative, I mean, if industrial is going to outperform in November or December, they're going to have to probably do it pretty soon. And we are right at a key support area. Financials, just drifting sideways, not really underperforming of late, but not really outperforming either. And you can see in the fourth quarter last year, we had a huge relative run. Not really seeing that just yet in this particular year. All right. Let's see what else we'll just keep going in some of these others. Healthcare, relatively breaking down below the lows we saw back in July. Healthcare has components that are aggressive, but they're more commonly thought of as a defensive sector. Biotechs are aggressive within healthcare. And I would say maybe even medical equipment to some degree. But there's a lot of, you look at pharmas, definitely pharmas are much more defensive oriented. I would say healthcare providers are more defensive oriented, and probably medical supplies as well. But this is a more defensive area, and it's underperforming while we were going through the correction. Went to a new low. How about staples? Look at what staples are doing on a relative basis. Hello, if we're going lower in the stock market, we should be seeing massive rotation into staples, not out of staples. Why would Wall Street firms be selling staples and getting into discretionary? Doesn't make any sense. And I like to follow common sense with the stock market. I follow the story the charts tell me, and I follow a lot of common sense charts. Real estate, another defensive area. Look at what's going on. Now, I know a lot of folks may be blaming their relative weakness on interest rates because interest rates were going up. Interest rates came back down from 5 down into the 440s. We got a little bit of a pop, but look at us. We're right back down to a new relative low here. Just, you do have some actual absolute price support just above 32 on the XLRE. Need to hold that. Utilities, another defensive area. What's going on here? We went down and set a multi-year low on utilities. And on a relative strength basis, we can go all the way back to early 2021. That was the last time we saw the utilities on an absolute basis down where we are now, or where we just were at the beginning of October. So downtrend in place on both absolute and relative basis. So defensive groups are going down relative to the S&P. Aggressive groups are going up. That's a clue. That is a hint. That's a big hint that this market is not going lower. It is going higher. Energy and materials, I call them neutral. They underperform and outperform during different markets. Sometimes one week they're big outperformers. Next week they're big underperformers. There's too much impacting energy and materials from all over the world. Geopolitical events, especially with crude oil. The dollar can impact many of the commodities in the XLB, which is materials sector. So these two groups I tend to stay away from. I mean, I don't think they follow technicals nearly as well as many other areas of the market. And so I personally just have not had a lot of success trading energy and materials. So I'll talk about them. I'll go through and show you charts and point out what I like, don't like. But when it comes down to it, I just don't trust the groups enough to trade them certainly not with a lot of confidence. Here's materials. You can see materials on a relative basis breaking down right here to the lowest level we've seen since back in September 2021. So that's more than a 2-year relative low. On an absolute basis, just going sideways, not really able to break out, also not breaking down. Maybe watch this 74, 75 area for support on materials. But when materials are going down like this, am I worried about inflation? Nope. I'm not. I showed a chart today in our weekly market report to members showing the aluminum chart where it went straight up until, I guess it was early 2022. And then aluminum's been coming straight down. Many of the commodity charts straight down. I don't think we're going back up with inflation. And I think if there's no problem with inflation and growth comes back down, we were really hot the last quarter with GDP, but most economists are looking for GDP to pull back quite a bit, maybe 1.5% growth. So if you have a low growth environment with very little inflation, with inflation coming down, that's actually a great environment for the Fed to begin lowering rates. And most firms are now, like Goldman Sachs, most of them are now looking for the next change in the Fed funds rate to be lower, not higher. And many looking maybe at that June period as when we could start to see the Fed cutting rates again. So, and the market looks ahead. I mean, it's November, but market looks 6 to 9 months ahead. So if the stock market really believes that we're going to start seeing rate cuts next year, middle of the year, we could see a really big move in prices here into year end and early next year. And that's what my signals are telling me. That's what my under the surface signals are all telling me at this point. Let me show you a couple of the signals I'm talking about. So this is the chart. I'll stretch it out so that it'll show up a little bit better on your screen. So this is a chart of the bottom is just the QQQ versus the spider. And you can see that the ratio has been going up since the beginning of the year. In other words, the more growth-oriented NASDAQ 100, which the QQQ is an ETF that tracks that index, that more growth-oriented ETF is outperforming the less growth-oriented spider. Spider is still growth-oriented. It's still got like 25%. Well, it's got 28% in technology, but it's got probably 25 to 27% in its top 10 holdings, which includes stocks like Apple and Microsoft and Nvidia and Tesla and Google and Amazon and so forth and so on. So when QQQ is outperforming the spider, to me, that's risk on. That means traders are willing to take risks. Now, this bottom part shows you what's been going on, including gaps. I've been running a user-defined index at Stock Charts where I do my own calculations. I ignore gap ups and gap downs because I think that's where most manipulation takes place in the market. And I'm only looking at what happened to the QQQ versus the spider intraday. And so you can see on an intraday basis, we just broke out. And even if you include the gaps, we're breaking out. So in other words, they're both signaling that we're in a risk-on environment. And that is not what you see when the stock market is about to get clobbered. If you go back to 2021, end of 2021, money was rotating away from the risk-on areas. The growth versus value ratios were declining. They weren't going up in December of 2021. And the first couple of months of 2022, as the market started going down, those ratios and aggressive versus defensive ratios, everything was tumbling with the market. I want you to look at what's been going on during much of this correction. QQQ versus spider went down initially, but since mid-August or late August, what have we been doing? As the market kept going down, the S&P kept setting new lows. These ratios were going up. Money was rotating into more aggressive areas. How many people on CNBC were talking about that? Instead, they're just scaring the heck out of you. Market's going down. Oh, we're going to go back down. We're going to retest those lows of 2022, October 2022. We're not going back down there. These are breaking out to new highs, which tells me the all-time highs are right around the corner in the major indices. Next one I wanted to show you, and we'll stretch this one out as well so you can get a better look at it. This is the XLY versus the XLP. These are updated through today's close, by the way. I did this right before we started this. So here you can see that the S&P 500 had been going down quite a bit. We saw a little bit of movement to the downside, including gaps. You know, here we broke down slightly below this low. But if we exclude gaps, what was going on with the XLY versus the XLP? Low, higher low, higher low. We kept going up. During the day, money has been rotating toward consumer discretionary versus consumer staples. Now, what I am watching, this is starting to move up. It hasn't gotten anywhere near the high from over here. And you can see this is already at that high, but we are down from the more recent high. So during the last month or so, we did see some deterioration, although the overall trend remains higher. So it's really hard for me to be anything other than bullish. And we have started to turn back up again. But if all of a sudden the S&P, is back up near 4,600, and we see this start to take a big dive along with this, both including gaps and ignoring gaps, taking big moves to the downside, that would be a warning sign. Now, it would only be one warning sign, and I have plenty of things I look at, but that would be a warning sign that we would need to think about. Is it really telling us something bad about the market? Right now, I see no problems at all. I see us continuing to move up. Do you remember last year when we went back down in September and October, put in a lower low on the S&P, took out that June low? Look at if we ignored gaps, money was rotating during the trading day. Throughout this huge, steep decline, money was rotating into discretionary. And then we saw industrials and financials lead the market. We saw this pull back, although you can see the low held from back in May. That low in December was still higher than the low in May. Here, going all the way into the end of the bear market, the S&P just kept going down. And if we included gaps, the XLY, XLP went down. But if we ignored those gaps, we never went back down to that May low. And now look at what's been happening. Up and away. Here the S&P's been going down, and look what the ratio is doing, going up. I don't make this stuff up. Anyway, that is essentially what I wanted to go over. So I'll be putting these portfolios together. Next week, we'll have an event for our members. We will announce the stocks that are going into each of our 3 portfolios. If you are not a member right now, this is a great time to join at Earnings Beats. First of all, you get a 30-day free trial, so that should be a no-brainer. You can come in not only to the event next week, but we have lots of events that'll be coming up. We have trading rooms on Wednesdays at 10 a.m. You're more than welcome to come to, even as just a trial member. So there's a lot of information that you can gather over the next 30 days to see whether or not you feel like our service is for you. But this is an absolutely great time to sign up. And I'll tell you one other reason to sign up and check it out now. We have our fall special coming up. It will begin probably in the next week or two. And it's our best deal of the year. So if you like our service, you can subscribe for a longer period and save a ton of money over the monthly rate. So anyway, lots of reasons to check us out over at Earnings Beats. All you'd have to do is go over to Earnings Beats. I guess I already exited that. But if you go over to Earnings Beats right here, right on the homepage, start your no-cost trial. Check that out. And then, see what you think of the service. We got a lot of very, very happy members from many of the calls that we've made, the market guidance that we've provided, all of the research that we do, and the education that we've provided to our members has saved some members literally hundreds of thousands of dollars in their portfolios, simply because we've been warning. We warned about the top in 2022, beginning of 2022, warned about, I think it was back in 2020 when the market topped beginning of September, warned about that. We've had some really good topping calls, but also some great bottoming calls that have allowed our members to take advantage of those. So anyhow, think about it, but would love to have you check us out. And like I said, this would be a great time to do it. So I don't know, John, if you've got questions, but I'd be happy to take a couple right now before we.
Yeah, we've got a couple. Let's start off with how long do you see this current secular bull market running?
Probably into the 2030s. Now, I do think we'll see cyclical bear markets along the way. I think I'll be talking more about 2024 in market vision. So I won't get into a whole lot of that. And I really want to see how we finish the year and what everything looks like. I think it would be premature to make that call. But somewhere down the road, probably sometime in 2024, maybe in 2025, we'll probably get another cyclical bear market where we'll see a 20% drop. But there are definitely some things that we can look at to kind of get a better feel. Whenever I talk about the market, I never provide guarantees. I never say, I guarantee you the market's going up, or I guarantee you the market is topping. What I always say is that it's all about managing risk. And if I see a bottom that looks like it's printing, then to me, the risk of being short is too great. I either want to be in cash or I want to be going long. And back at the beginning of 2022, I didn't immediately say, hey, let's all jump in on the short side. What I said at Market Vision 2022, before the cyclical bear market, I said, we have a lot of warning signs that suggest to me that it is not worth the risk to be long. That's what I said beginning of 2022. So cash, and then if breakdowns begin, that's when I would start looking for a cyclical bear market. It was on, I think, Saturday, January 7th or 8th. I think it was the 7th, 2022. And I said at the time when the market was still above 4,700, I said my worst case scenario for the S&P 500 was a drop back to 3,500. And our low 10 months later came in at 3,491. So these market vision events, I mean, they're called market vision for a reason. We try to give you our vision, what we see going in for the year. That's going to be an absolutely massive event coming up in January. Better mark your calendars for that. But again, I don't call guarantees, or I don't provide guarantees. I just tell you what I'm seeing. And I try to be honest, both on the long and short side. I will call tops. I will call bottoms. I'm not perma anything. A lot of people think I'm perma bull. That's because I'm bullish more than I'm bearish, which if you look at this chart I showed you back at the very beginning, would you rather be bullish more of the time, or bearish, more of the time over the last 100 years? Hopefully you look at this chart, you probably want to be bullish much more than you're bearish. So it's all about perspective. All right. Anyway, you got another question?
A couple. Somebody's asking why anyone would want to buy airline stocks here. And then two specific stocks. Somebody said they're stuck in LTHM and CFLT. And what would your thoughts be?
All right, let's see here. All right, first, airlines. What's really funny about airlines is back at the beginning of July, I'll be honest, I loved them. I mean, I thought we had this beautiful breakout here from earlier in 2023, had great volume trends. Everything looked good on this group, and it all completely fell apart. But the reason I'm bringing this up is I don't know that airlines could have looked much better than they did at the top. And then after this huge decline, of course, nobody sees a reason to be in them. But if we're in a secular bull market and we're going to go higher and Fed's going to cut rates and interest rates come down, there could be reason to like airlines here. I mean, we're seeing a lot of more hollow candles now. I mean, mostly we saw just red filled candles on the way down. Starting to see a lot more hollow candles, which makes me think that we're seeing some accumulation. AD line's been moving up. So I'm not saying I'm going to jump into airlines for our portfolios, but this is probably the best the airlines have looked since back in June and July. And they are definitely a very, very beaten down group. I think we got more work to do. Let's get through the 20, more definitively. Then we've got a challenge up at the 50. But I think we can get back through the 50. I think this is a group that could make another pretty significant run. The individual stocks, don't really like doing a whole lot of those here during this session. But I'll take a quick look. I mean, stocks, you got to have stop and play. I mean, this thing broke down back in probably the latter part of July, and it's just been going down one after another, after another, after another. I mean, 29 to 13 in 3 or 4 months. listen, I've been in the market for a long time, and I've held stocks and taken a bath in stocks before like this. And I learned, I paid my tuition at, on Wall Street, and I learned that you've got to have stops in play. You cannot allow a stock to go from 29 to 13. I mean, these types of losses just ruin your portfolio. It's hard to overcome, these kinds of losses. So, right now it's closing in a new low. Look at the volume. I mean, there's a reason. Look at the AD line. Everybody is getting out of this stock and has been for a while. I mean, you don't want to sell when it's like at a low and it's been butchered, and we just saw it go down, from 18 to 13 in the last 3 or 4 weeks. But any kind of a bounce, I mean, if this thing were to bounce and get back up 14 or 15, I would just lick my wounds and get out, and probably consider doing it now and just say lesson learned. CFLT, this one was more just on the gap down. This is much more difficult because this was 28 to 16 on the opening bell. We are trying to see a recovery. Let's see what the weekly looks like here. I mean, yeah, we went back down to this low. I think at this point we've dropped. We got all the way down into the 14s. We're starting to recover. I think if I've held this one for a while, I probably just put my stop in where the recent low is. If it goes back down below that, I get out. And if I get a bounce, anything back into the low to mid 20s, I'm going to take it and run. Because it is downtrending. I mean, even if this stock got back up to 25, I wouldn't trust it. It's got to get back through both these moving averages on the weekly chart. So this was a stock actually I liked probably back in here when it made this breakout and was moving up on volume. Actually, I think I may have traded this one back over the late spring or early summer months, somewhere in here. Might have been on the pullback, might have been on the breakout. I don't really remember. It's been a while. But yeah, I mean, this unfortunately is just a little bit of bad luck. That was with earnings, by the way. And so the way you eliminate the risk of earnings is you just don't hold stocks into earnings. There's nothing that you can do I guess there are some option strategies and so forth you could employ, but there's not a lot you can do to offset the risk of holding a stock into earnings. And this is, most companies don't go down 35, 40% with earnings, but they're certainly capable, especially these smaller growth names. If they all of a sudden lower guidance or something, they can get a very, very significant haircut. What else you got?
Let's go ahead and wrap up. Somebody's just making a comment that they thought China said they would renew the Boeing order. So that's just a comment on airlines. And then let's end with, what do you think about regional bank stocks in light of commercial real estate fallout? Bank loans might hurt the banks. Default rate is increasing.
Yeah, that's a great question. I mean, you can't be bullish the small and regional banks right now. I'd like to be, because they're beaten down so much, but I do think that there's still some more fallout to come from commercial real estate. I don't know what it's like all around the country, but I know, when I go into Charlotte, I know that there are a lot of vacancies, a lot of empty office space in Charlotte. And this is a pretty good area economically. So I'm guessing that this problem is pervasive throughout the entire country, probably throughout much of the world. And I don't know if it's going to come back the way it was. So this is a really tough call. And it impacts the KRE I pulled up, which is the regional banking ETF. I mean, if I was going to do it, I would probably do it with something like this, getting in to the KRE, as opposed to trying to pick individual stocks. The only way I would do individual stocks is I'd have to have a lot of knowledge. I'd probably have to do a lot of fundamental research, because I am worried about the commercial real estate market and the impact that could have on some of these banks. I don't know if they've all taken some of the hits that they may need to take at some point down the road. So banks, from a banking perspective, I would stick with some of the large cap leaders. JP Morgan. I mean, if I was going to be in banking, it would probably be JP Morgan, hands down, over just about every other bank out there. And as far as the regional banks go, if I wanted to take a shot, I would do it with an ETF like the KRE. I would not try to go into individual stocks. I think if you get an individual bank, I mean, we've seen what happens. They'll protect the depositors. They will not protect the shareholders. So if you're in a stock and they come out with an announcement, something about, bad commercial real estate loans, they're going to have to write off more than they thought. It could affect their liquidity, blah, blah, blah. I mean, we've seen what's happened in the past to some of these smaller banks. So, if there's one thing that still keeps me up at night, it's probably these small to mid-sized banks. I mean, if there's one thing that I worry about. But the market outside of the banking area doesn't seem to be too concerned with it. You've got the inverted yield curve. I think that'll start to unwind probably in 2024 to some degree. But that still, I think, is putting pressure. It always puts pressure on banks. I audited banks. I mean, net interest margins get squeezed. So this is not a good thing for banks in general. But the question is, do the banks suffer the kind of losses where they stop the credit availability, where they, it really begins to shrink? And that's when it can have an impact on many other areas of the market. So far, from what I'm seeing, it's still all pretty much contained in the banking area. And the way the market is trading, stock market, Wall Street, big firms, they're not worried about any kind of fallout from the banks. So that's the best I can answer. I don't really have a definitive answer. I would just be really careful if I got into this area. And if you're looking at it saying, I think it's beaten down, I want to get in. I know it maybe isn't as sexy, but I think the KRE or something like it, an ETF that has a, massive, large basket of individual stocks so that you don't take on that individual bank risk. That would be my suggestion. But anyway, that's it.
Let's wrap it up.
All right. Sounds good. So anyway, we're going to be doing this next week. I will be getting back in touch with members a little bit because I believe we might have the next event set up for next Tuesday. And if that is the case, we may have to change it, maybe to do sometime over this weekend, or maybe even on Monday after the close. I might have to just let everybody know what the stocks are during the trading day, and then we'll talk about it after the close. I don't know what we're going to do, but we'll keep members posted on that. But for some reason, I'm thinking that next Tuesday or Wednesday is when or maybe even Thursday, because we were thinking about the 25th, doing the draft, but I don't want to do that in November. I want to actually do it as of probably Monday's close next Monday. So anyway, we'll be notifying all the members about that. So again, check us out. Go to earningsbeats.com. If you are not a member, please check us out. We've helped a lot of folks in the market over the past 5 years, going through a lot of stuff. I think we're really good at what we do in terms of market guidance, market research, market education. If you're looking for a firm that's going to give you the next great hot stock tip, I don't look at us as that. We provide trade setups and we do a lot of things that, give you some ideas of trading, but just to have a service where you're just handing out stock picks, that's seemingly crossing the line. And in terms of, needing to have a license, I just don't think that is what services like ours should be doing. I think we should be providing mostly education, research guidance, that sort of thing. And that's what we do. Anyway, check it out, because we do so much. I can't even explain all of the different chart lists and all the research and everything that we do for our members. And of course, the top-notch guidance. Fall special coming up soon. Keep an eye out for that. But make sure you check out our service so you can take advantage of that fall special. Have a great evening, everybody. We'll be back tomorrow morning for Trading Places Live at 9 a.m. You can go into YouTube and we will start the show promptly at 9 a.m. So have a good evening, everybody. See you in the morning. Happy trading.